Hi there, it's Callum Newman here. If you're a fan of Game of Thrones, you'll know that Robb Stark is one of the characters, and he threw up his banners and he was the King in the North in that book. Well, I'm here with the real King in the North of Australia, Warren Ebert, who is the CEO and co-founder of Sentinel Property Group. Warren, thanks for coming in.
Thanks, Callum. Always a pleasure.
I have it on good authority that you could be in Sydney with Erin Brockovich today, but you're actually down in Melbourne here with me. So is that true?
No.
No?
Yesterday was Erin Brockovich.
Yesterday was Erin
Yes.
Brockovich.
So I had two of my senior staff went down. It was an ESG event put on by Commonwealth Bank for their major clients, and we are one of their largest in Australia. And it was all about ESG, but my boys said we're all on top of it. So it's nothing new for us.
The reason I bring that up is because you're rolling out solar panels, right, across a lot of your properties?
We're doing one large shopping centre we have in Mackay. We're almost finished putting 5,300 panels on it, so it'll be the largest on-roof installation north of Brisbane. We have one in in Cairns, where we have 3,200 panels on it. So we've been doing that for some time, and solar really makes sense for a shopping centre. For residential, it really isn't that good because you're getting your solar energy during the day when you're at work, and when you need it, there's no sun out. Where shopping centres, your big use is during daylight hours, which is the air conditioning particularly. So for shopping centres, solar works extremely well. But what a lot of people don't realise is most buildings weren't designed for solar. So when you get your big tenancies, quite often your big W came up those, because of the big roof spans, they can't take the weight of solar panels. And that's one of the problems you have with industrial. Industrial, you want big roofs, big roof spans, not many columns, clear span. And the roofs in industrial are designed, the problem with wind is you get the uplift, it's not the force down. So they're designed to stop the uplift. They're not designed to be covered in solar panels. So that's for a lot of people probably not much interest, but that's why you don't see a lot on industrial properties. Not much sense with offices because offices don't have a big roof space. But for shopping centres, it works extremely well, very efficient, and makes a lot of sense. If we will save about $1.5 million year one on our electricity bill.
Well, that's the point I was going to get to. Like, it's a cost cutting thing. So I first came across your work in 2022 when you put a warning out and it picked up by the AFR, and you were saying that some of the industrial managers were going to get smashed because they'd bought on low fixed yields, and we had the inflation and rate rises coming through. When you look back now, 2 years later, did that play out?
I stand to be corrected. I don't know if I just said industrial.
I just checked the article. I'm sure they quoted you as industrial, but you may have meant something else.
Well, certainly the people who are buying at those low yields, and they are getting smashed. I'm trying to defend myself, Callum, because industrial has held up extremely well. One of the things we've seen because of increasing construction costs, and that's probably a whole new session, but we've seen construction costs. A quick example, Mackay, where we were doing smaller sheds up there, 4 years ago they were 2.4 million. It's now 6 million. Now that's a construction only. That's not land. That's not holding costs. And for those type of sheds, you put them up in 4 months, 6 months with a bit of rain. So construction costs have gone up 2.5 times. So rents are going through the roof. But we have seen, because construction costs are going up so much, what you're seeing is enormous rental growth. And I think you've seen with Centuria Industrial Fund, I think they're quoting average 38% or something like that. Some of the rent increases you're getting are enormous, and that has saved the industrial funds. Now, they may say 3 years ago when we bought, we saw 50% rent increases. I doubt if that's the case. But industrial has held up remarkably strong.
Well, I mean, you weren't wrong in the broad brush. I mean, with me following the share market, all the REITs were hammered over the last 18 months as that inflationary dynamic and the rate rises and all the fear around that. That's part of why you're so excited, right? Like, you're not a share market guy, but surely there's properties out there that have gone into distress like they have on the share market.
Well, Callum, one thing I've got to say, I look at a lot of properties and I've never actually seen a property in distress.
Oh, really?
No, I see the owners in distress.
Okay.
I've never seen a property in distress. So they don't care. The owners are, and you've only got to have and it's public knowledge, and I'm not picking on anyone in particular, but I think Mirvac at their 6 monthly report said they need to sell, or they're going to sell 1.2 billion Charter Hall, I think the quote was 550 million from their long WALE fund. There's another group we're talking to, they're 200 million by June 30. Now
this is to reduce their gearing. Is this what you're driving at?
Yeah. So there's 2 billion in just three we know. And there's, I think if you have a look, none of the REITs are buying commercial office space. None of them have bought major shopping centres. We've seen the Charter Hall retail fund selling a few shopping centres and reweighting into some quality ones. Not there's anything wrong with what they had, but it's just what they're doing. Industrial, you've seen a few people buy, but certainly in the commercial office, there is enormous pain. I've been out here in Melbourne now for a couple of days, and it is terrible, and it can only get worse. But some of the opportunities we're seeing, I think particularly in Queensland, in Australia, your major wealth is in Sydney and Melbourne. That's both private and institutional wealth. So that's where they tend to spec build office buildings. I looked at one yesterday, be finished in 2 months, 60,000 square metres. They've got 15,000 pre-commitment in the city, and people are moving out of the city, so it's only going to get worse. So in Brisbane, we didn't see that speculation. And what we have now with a friend of mine who was buying a unit very close to the city at New Farm, they're now not developing that. Construction costs went from 28 million to 48 million. So we're not seeing new offices getting built. There's one being built by an institution, and I'll be very surprised if they go past podium level. So we've got the population growth in Queensland is a bit higher than any other state. Construction costs, I think, are higher than any other state. We have, what the state government call best practice construction contracts, which mean people get paid a lot for not doing very much. And I've got friends of mine who are large developers who just aren't doing anything in the foreseeable future.
So the whole work from home thing, though, if anyone's watching this, are there going to be staff to go into those buildings?
We didn't have those issues in Queensland. We didn't have the 8 months lockdown. I think we might have had a week working from home, and we're quite, accommodating with that, and said any of our staff want to keep working from home, they can. They just have to work for another company. We're not having that, and it's just, when you get the young people, how do they can't learn from home. They all want pay rises and promotions, which is understandable. But if you're sitting at home, you can't get that. Now, if you're doing data processing or something, that's probably okay. But in the property industry, when you've got to, and it's not just property, but a lot of areas where you need to learn off more senior people, and you need that buzz around you. You need to be able to just ask the person beside you. If from home you just can't do that.
Well, you often say when we have a chat, and we'll say you'll go, "Oh, that guy's a property person," or that person is maybe more of a financier kind of thing. Well, what makes a good property person?
Not being overly educated.
Okay.
Well,
you fit that bill. No, I'm joking.
Yes, no. I left school at grade 10, and then it was only when I got into property and I was talking to some of the REITs, and they talk about the internal rate of return and the DCF, discounted cash flow, and I said, what the bloody hell is this? I better learn. So I went and did valuation at night then, and I realised yes, you need to understand it, but people, I say property is a simple business, Callum. I'm looking at some buildings over here. They're made from glass and concrete and copper, and they're not complicated. People make them complicated. On the first Tuesday of every month, the Governor of the Reserve Bank at lunchtime does not know what interest rates will be that afternoon. You'll get these propeller heads, as I call them, work for these big institutions. They'll look at a property, and they'll do a 10-year DCF. So in order to do that, you've got to know what rents are over 10 years. You've got to know what interest rates are over 10 years. You've got to know what your outgoings are. So your rates, your land tax, your incentives. So they know all of these things over 10 years, yet the Governor of the Reserve Bank doesn't know what interest rates will be that afternoon.
So what do you guys do at Sentinel then? That's different.
You go and look at a building and say, if I can buy this for $5,000 a metre, that's a deal. Then you'll do your due diligence on your air conditioning and your lifts and all those other things. We don't sit down and do a DCF. Because you can't count on that. Who counted on Russia invading Ukraine? Who counted on what's happening over in Palestine and Israel? Who counted on what they're doing, in the Red Sea with destroying ships and all that? You can't take those things into account. So I just have a look. What return can we pay investors month one? The capital growth is a bonus. We certainly like to get it, and we pretty much always do. But you can't count on getting it 2 years, 3 years, 4 years because there's events outside your complete control. So
you're very excited for this period, though, right? You're getting in front of people and saying now's the time to strike.
I'm like a dog with two tails.
Okay.
It's in the GFC when I started the business. What we saw then was there's vacancy around, so you leased up the vacancy and you got what we call cap rate compression, capitalisation rate compression. You didn't really see a lot of rental growth because in the run of the GFC, there was, in most areas, a lot of excess property built. So you had retail around, you had large format, which was called bulky goods back then, you had offices. So it's really about getting them leased up and waiting for the market to recover, which it did. But what we're seeing now, which we've never seen before, is rental growth. You go through, well, you're seeing it with in residential, that everyone knows what's happening with residential. And honestly, I don't know what we're going to do in Australia. We don't have the population to build the accommodation that we need. And the government, I was going to say they don't have a plan. They have a plan, but it will fail. There's absolutely no doubt it has to fail. If the government was to give you 200 million, Callum, to go and build 100 houses, well, what you have to do, you would have to take my staff, you'd have to take Campbell's staff. You've got to get more staff to do that. And what you do is you will pay those staff more. Now, you will fulfil your contract with the government in building those houses. I can't build any. Campbell can't. So between all of us, we don't build any more. But the ones you've done for the government cost more. Now, if you can tell me how my theory is wrong, please point it out. We do not have enough workers to build the houses that we need. And what the government is doing by throwing money at it, yes, they're providing. We're seeing up in Queensland more low-cost housing, people for homeless people, and that's all necessary. I'm not arguing that's not necessary, but that doesn't create more housing. And what it is doing is pushing the prices up. It's getting to the stage where we've seen some that we've got some involvement in because we've started a modular housing business bringing things in from overseas. It's getting to the stage where these properties cannot be bought by what we'd call the average worker. The government is the only one who can pay them because they just hide the cost. So it's so that's happening in residential, but we're also seeing that in office now. In Melbourne, you're fortunate you don't need to build anymore. Like it's got a decade of pain, or probably more.
But hang on, just something that I was at your presentation for the one that you bought in Melbourne. You bought an office tower in Melbourne.
Not Melbourne CBD.
So it's Melbourne CBD you're referring to.
And now there was an article.
The pain zone.
There was an article in the Fin Review last week, and I should have cut it out, but there was some highly educated person who I think was head of Value Generals, something, whatever they called in New South Wales, and was also a lecturer at some university. And it was a good article talking about the vacancies in the CBDs and retail, everything else. And the only trouble, he didn't differentiate between Sydney, Melbourne and Brisbane. It's like saying, the temperature is comfortable. You've got the head in the oven, the feet in the freezer, and on average you're fine. But you're dying at both ends. So he was quoting across Australia. Now, in Melbourne, the vacancies are terrible, and they're only going to get worse. I had a look at a lot yesterday. There's a lot of new stock coming on, and there's just not the demand. They're moving out of the city into the suburbs. Now, they're not building anything in the suburbs because, once again, there's too much vacancy in the city, and a lot of the people they just can't build anymore. So in any market, whether it's the housing market or the stock market, Callum, there's always deals available in good markets and bad. You've just got to pick out where they are. You can have the stock market booming, where you have a look in the US where it is the Magnificent Seven, whatever they're called. They're booming, but there's a lot of sectors there that are actually down on what they were 12 months ago. So there's opportunities everywhere. You've just got to have a look and pick out where the opportunities are. So
going back to that November presentation, you sort of you was pointed out at the time the stock market was in the dumps and it hadn't gone anywhere for 16 years, if you didn't include the dividends kind of thing. When the stock market starts to lift as it does now and you've got deposit rates quite high, is it harder to get money off people when you go to people, or are they willing to go with you because they want to be?
It's certainly harder. When people can get, I don't know, 4 and 5s, and I know there's some bonds that they get, ANZ ones, which they call risk-free, but, as with the US Treasury bonds, which are risk-free, and you've had banks just wiped out because they had too much risk-free investments. And interest rates come down, the bonds become worth zero. Or it's not zero, but worth a lot less. So I think pretty much every bank in America, because I think they have to have something like 30% of their assets in T-bonds.
Yep.
Now, if they had to cash them in today, a large percent of the banks would go to the wall in America. Now, the government doesn't force them into cashing them in. So certainly it makes it more challenging to raise equity. But what that does is means there's less buyers. So you get better opportunities. So I like it when it's tough.
Because you often reference Warren and the whole be greedy when others are fearful type of thing.
Warren Buffett, for those. The other great Warren, as they say.
Mm-hmm. So if you go back to November, it was a bit of a spooky time then because, the yield in the US was soaring and the share market was in the dumps. And that's when you moved on that office in Melbourne, right?
Mm-hmm.
Do you feel like things are better now than they were 5-6 months ago? Or, where do you see...
You mean better for raising equity?
Sentiment-wise. Are people getting a little bit more comfortable with where the world's at?
I wouldn't say that. I think because when you look at, the stock market certainly is performing well, but I think people are cautious there with, does Trump get elected? Which probably he does. What does that do? He's talking about putting 10% tariffs on all imports. If he does, what does that do? It certainly has to have some serious effect around the world. What will that be? I don't know. I was reading some charts on the weekend, and when you look at GDP per person in Australia, we've been in a recession for the last 4 quarters. Now, because of immigration, it's the old lies, damn lies statistics. GDP is increasing, but not on a per person basis. So the people that spend the time to read this information know that there's issues out there, but that creates opportunities. I don't like to see when it's steady. That's no fun.
And is yours focus still, I refer to you as the king in the north because part of your sort of thesis for the next 10 years is a lot of wealth creation will happen in Northern Australia. Are you still focusing there, or you're willing, obviously, now to come down to Melbourne and Sydney and look around as well?
We'll buy anywhere where there's great deals. I say we'll buy anywhere, anytime at a price. The price may be $1, but we've just got to look for deals. But as far as long-term economic growth, the wealth for Australia is being created in Northern Australia. Not, if you can show me what minerals and coal and iron ore and crops you grow in Sydney and Melbourne, I'd be interested to see those farms. No, they just, the money gets shuffled around. They actually don't create anything. There's very little manufacturing. So the wealth is being built, created in Northern Australia, whether people want to admit it or not. All they do down here is try and close down the coal mines, the iron ore, the gas, and everything else that creates their wealth and the taxes for us to have the quality of life we have. But that's another story. So still super bullish on the north. Of our 1.985 billion, which is actually over 2 billion because our industrial fund's up 50 million in the last 6 months, even though things are tough. Of the 2 billion, we have 1.5 billion invested Mackay North. And we're very relaxed with that. We bought the shopping centre Caneland in Mackay, December 22. It's at the highest mining boom. The peak of the mining boom was about 2014. And then it came off. Now, the last, as of Christmas, we've got the highest turnover in that shopping centre since 2014. It's up over 400 million. We paid 280 million. Replacement cost is over 800 million. I don't think we'll ever see another Westfield-style shopping centre built in Australia, because when you build those, you would have a Myer or a David Jones or both. Coles, a Woolies, a Big W, and a Kmart. And
key tenant, you mean?
Sorry?
Key tenants.
Yeah.
Anchor tenant.
And you need those to get your couple hundred or 300 specialties to make it work. Well, everyone knows there's no more Myer or David Jones. I think they've probably closed down all they need to, and they've got a model that works, but they're not going to do any more, and they can't pay the big rents. So that creates enormous opportunities. But yes, the north, Townsville, I don't want to live there because of the weather and everything else. What's happening in Townsville is just absolutely phenomenal. You've got
what's happening in Townsville?
Well, I'm glad you asked.
I've never been to Townsville.
You've got in Mount Isa, which is some distance. It's 900 kilometres from Townsville, so it's just around the corner.
Yeah, it's Queensland sort of
Yeah,
distance.
but they've got $500 billion worth of proven resources there. Now, there's a lot more. That's just what they've proven. Now, the state government bought a project called Copper String 2, so they're running the national grid electricity out to Mount Isa. What that then allows them to do is start doing some initial processing of these minerals. And some of these minerals they talk about, Callum, I don't even know what they damn are. But, to build new batteries, new technology, they've got to have it's no longer just, copper, lead, silver, zinc, all those things, these other palladium, rare earth things. Now, they've got them all out there. I don't think there's any of them in Melbourne. But anyway, they are
I don't know
up
anyone's looking for them in Melbourne.
Yeah, well, they wouldn't know what to look for. But they are up there now. In addition to that, they're spending $255 million widening the shipping channel in Townsville from 92 metres to 180 metres. That will then all come down. They'll process it there in Mount Isa, and then it'll come out through the port of Townsville.
So what you're really saying is this virtuous circle of where wealth creation in Queensland from the private sector, that flows back to the Queensland government. They then reinvest it back into the state, and that sort of lifts the value of the things that you're accumulating.
Yes. Now, one of the largest defence base in Australia now is in Townsville. Now, there's another, I think it's 700 tanks are moving from Adelaide up there, I think, later this year, early next year. Now, there's 3 people in every tank. That's 2,000 people plus support staff. They'll need another couple of thousand homes. Now there is, they just don't have the people to build them. We in order to get the tradies into building, you'd have to build more houses to get the tradies in, and we're just not doing that. So we have some serious issues for infrastructure. We don't have the people, but out of that creates opportunities where you can buy assets far, far below replacement cost. Rents are increasing, but that's why we've started this modular housing business. We're not really builders. We're not into domestic housing, but you have to do something, Callum. And the with the state government, and particularly in Queensland, they're doing a modular housing factory at Eagle Farm, which is near the Brisbane airport. But what they do is bring 200 tradespeople from the suburbs, put them in a warehouse, and they build modular homes. Now, that's great, but you don't have the tradies out in the suburbs. So once again, it doesn't create any more housing. They say we're doing more efficient and everything else, but you're not creating more housing. We need the people now in Darwin and Townsville, which I have some experience in. Pretty much all of the houses are built with Caulfield block work. So you might call it the old Besser block. People would know them by that name. So you build that right up to the roof, so you can tie your roof trusses in. You fill them with concrete, put steel reinforcing bars in them, and that's how you give the rigidity for cyclone rating, and then in Darwin for earthquake rating. I think the average age of block layers is 64. In Australia last year, there was 3 block layers finished their apprenticeship. Now, I know you've got young Campbell here now.
Can you imagine him trying to do that?
I couldn't imagine him doing a lot with his hood and everything else. But, I think in fairness, if you went to any high school and said to, who wants to be a block layer, I would think a large percentage wouldn't even know what block laying is. Now,
I've never heard it. I know bricklaying.
Now, up in Northern Territory, you get $16 a block. So you can actually earn big money. But it's bloody hot. But you can start at 5 a.m, finish at lunchtime, I don't know, make you $1,000 a day, whatever it is. But it's a dying trade. I think in bricklayers, it's like average age.
You sound a little bit like Jim Rogers. You know Jim Rogers, the former hedge fund manager? For years, he's gone around the world saying the average age of farmers is like 66 and there's going to be no food because everyone studies public relations and marketing.
Well, what we're seeing in farming is it's become more mechanised and you can produce more with less. And they're trying to come up with these robots to do block laying and bricklaying and all that sort of stuff. So they are making, but it's very slow progress. But it just gets down. We have a terrible shortage of tradespeople. And now the government's, bringing out some other thing where they want, was it 90% of people by 2050 to go through university? Well, you don't need a university degree to lay bricks and cut timber. Now, you need an education. I'm not doubting that, but we actually need. I'm looking at it. Do the buildings, do the cars. Like we need tradespeople. It is so far underestimated the value of tradespeople. And if you're a young person who can do plumbing or something, you can travel around the world cleaning out toilets. You know?
You make good money too.
Well, yeah, you can go anywhere, and it's easier to start your own business. And I just think that that they all need to go to university, I think is just absolute rubbish. And they downplay the importance to tradespeople in the economy.
But it gets back to that dynamic, right? That the replacement cost is driving up the cost of construction. You've got rising rents, and hence the opportunity in commercial real estate.
Like we haven't seen before. There's more opportunities, I think, this year than what we had in the GFC.
So Sentinel started with you. What was your initial, how much did you start? Like you're $2 billion now. It was much smaller originally, right?
Started with zero.
Okay, that's a big change. So what I'm driving at is, with you in the business, obviously this beast is getting bigger and bigger. Are you focused on acquisitions or your existing stuff, or what do you see your role now?
Well, all of those. My role is to get returns for investors. Now, yes, last year we only bought one property. So the year before we bought over 800 million. Last year to December 31, we bought one property in December for 3.2 million in Mackay. Replacement cost was 8.8. Now we happen to have a tenant who has taken new 7-year lease on the whole lot, a government tenant. Now that was 8.8 for construction. It doesn't include land, so you're about 10 million. We paid 3.2. So you might work out there's an.
Why was it such a good deal?
Vacant office building. People didn't know what to do with it. We had a tenant, and that's what happens when you get out and talk to people, talk to tenants, have the capacity to buy the building without any income, without a tenant.
Cash buyer, sort of.
Yeah. And a lot of people don't, as you say, you've never been to Townsville. I don't know if you've been to Mackay. A lot of people haven't. There's a lot of wealth up there, a lot of growth, and it has to keep going. So the property we bought here in Melbourne was on the 31st of January. So we bought 800 million in 22, 3.2 million last year. We spent 80 million 31st of January. I'm hoping we can buy about $1 billion this year. But we have to keep adding value to all of our buildings, driving the rents, making sure the buildings are quality. If they're not, we have a lease with the tenant. So if it's not clean, if there's a problem, let us know, because you're paying rent that it should be clean. Things should be in order. If there's a problem with air conditioning or a leak, I want to know about it because it should be fixed. So you can't just focus on one sector. You've got to do all of it. But we have 123 people, across. Looking at all those areas.
$1 billion's a lot of money. Where do you find that kind of capital?
I'll talk to you after this, Callum, and hopefully you can help us out.
Absolutely.
We'd need about 600 million in equity, so it's a total $1 billion. We'll be borrowing the rest. We have some fairly substantial investors, and we don't have any institutional money. We're not institutional. Fund. We find that they like to invest at the top of the market when it's overpriced and then sell at the bottom. That's how they do it. And anyone who disagrees with me, you can have a look at the facts and see who are buying now and who's selling. So it's,
We've seen, you alluded to the US before, some of their commercial real estate get into trouble. Are you surprised that there hasn't been more trouble here in Australia and with banks making loans against some of these properties?
Well, I suppose first off you could say yes, but when you talk about America, there was a Westfield shopping centre that Rodamco, Uniball Rodamco just handed the keys back to the banks. $500 million centre in San Francisco. Now San Francisco's just had it. Another story. And one of our large super funds here in Australia had a building in New York that I think they only bought in 2022. Now they've just walked away from that. Interest rates there got up to, I think, 5.25. We're at 4.35. If we had another 4 interest rate rises here, things would be different. But our banks here are in a much better position. In the GFC, our banks had serious problems, so they had to do something. With what APRA has done and everything else, our banks are very, very solid. They're making two things. They're making record profits. So when they're making record profits, it is a bit hard for them to foreclose on people. So they're charging penalty interest. If you look at the research, I think there's more housing in arrears or getting close to arrears than there was in the GFC. So there's problem there. And that's more in numbers, but percentage-wise, it's probably not. But the houses have gone up a lot. They've probably almost doubled in Sydney, Melbourne since the GFC. but the banks are in a very good situation. So we haven't seen the banks, stepping in at this stage. What they're doing with a lot of the people saying, you need to refinance, and if they don't, they charge them penalty interest. So the banks are having a win there, but they're running a business. They're not doing anything wrong. People just paid too much.
And how you at Sentinel play the interest rate thing? Do you guys fix your debt, or are you happy to leave it variable and sort of run the risk?
We just run with it. It's I've had some serious clients of ours, and I had one call me a few years ago, and he was with his bank manager. He called me to ask for advice. Should I lock in? And he said, my bank manager here is telling me I should lock in. I said, okay. But I said, who's paying his wages, you or the bank? He said, the bank. I said, oh, well, I wouldn't be going with what he says. The banks are there to make money. Now, they'll say they give unbiased advice. I think there's probably plenty of court cases and government inquiries that say that isn't always the case. Now, we have a good relationship with banks, but it's the old buyer beware. They don't.
And if rates do come down, that's part of the tailwind for property, right? Because you get the expansion.
Well, when interest rates were, what people forget about cycles, Callum, is cycles actually tend to go in cycles.
Mm-hmm.
Now, when interest rates were down at zero, they could go minus. Unlikely. So
when people did think they could go minus.
Yes. And in Europe they were minus a little, minus 0.1 or something. But when they're at zero, there's a fair chance they're going to go up. And when they're up, now there's still some people think we're going to get another interest rate rise, and I'm not going to argue against that. But there's a lot of evidence around to say that we probably won't. And I read some research on the weekend, and there was something from CBA who seemed to be probably more accurate than others, and they were forecasting 0.75 interest rate reduction this year, another 0.75 next year. Now, I don't know, and we're not buying properties based upon that, but I think the general belief is that interest rates have peaked and they will come down.
Would that then give you the best of both worlds, because you've got those rising rents and then your debt cost is coming down, right? You'd love that, surely.
Yes, exactly.
You would.
Exactly.
You've got a glint in your eye.
Yes. and I get goosebumps. This is the best opportunity for more than a decade. As I say, the rent increases now. I've seen stuff in Brisbane. I won't nominate the tenants, but they're very well-known tenants. And the offer they've had from their landlord will increase their net rent 50%.
That's 50%. Pretty good.
And there's more in it because they're just not building new stuff. And what we're seeing for the first time is incentives are coming down to levels. We've done a couple of deals in the last few months where there's been zero incentive. Now, that's just 34% rent increase in zero incentive. Now, that's unheard of. And I don't think most people, some of these lease deals we're seeing with massive rent increases and low incentives, they're not public knowledge because the leases haven't been done. But when you get out and talk to the agents, see what's happening, the opportunities are fantastic. We're talking about the interest rates, Callum. My view is if you can make something work at the current interest rates and with the gearing, and yes, we have a high gearing, and I'm happy to take on anyone with that. We look at interest cover. Now, a lot of other funds will have much lower interest cover than us, but when they buy at 3 and 4%, you need to have low gearing.
Well, it's funny you say that because the legacy, because I went over a lot of the REIT stocks, right? You correct me if this is wrong. A legacy of the GFC was that a lot of those guys sort of mandated we're only going to have 25, max 40% gearing, right? Because they don't want it. They got in trouble last time. They don't want to go there again. So that in turn is like a discretion that you have that's advantageous, right? Because you're just got more monetary firepower. Can be more aggressive?
Callum, I have to be a little bit careful what I say, and I don't want to call them dickheads because people might take offence to that. But in the run-up to GFC, when they were buying at 6% yields and borrowing at 7%, I think if you get a calculator out, you might see that doesn't really work. I'm not a mathematical genius, but I think it's probably the case. And I had one of the larger REITs who, they got into so much trouble, and I won't say who they are, but they had 3 letters was their name. The last one was a P. And when they told us that we were too highly geared, I said, well, we have on average 3 times interest cover. What interest cover do you have? And they couldn't even tell me. So you've got the hide to tell us we're too highly geared. Now, we're buying at 10%. We could have a 65% gearing and have 2.5 times interest cover. When they were buying at 5%, they didn't have 1 times interest cover. So it's never the debt that causes the problem. It's the inability to repay that causes the problem. So, and it's the same as what's happening now. Now, I had dinner with some of our investors the other night and a couple of his friends, and he was saying, well, but, if you buy something at 3%, and now interest rates gone up to 6%, of course you've got problems. And I said, we didn't. He said, but yes, if you buy at 4%. I said, we didn't buy at 4%. He said, well, even if you bought at 5%. I said, we didn't buy at 5%. We bought nothing under 6%.
So are those yields still out there? There's kind of 8-9% sort of stuff?
Well, we bought Richmond at 9.32 on the 31st of January. So, yes. On the 7th of December 22, we settled a industrial building in Mackay with a new 10-year lease to a German international, very, very big, been going for 300 years, so they've been around a while. New 10-year lease, 4% annual increase at 8.8%. They're there. If you have 500 million and you say, we have to spend this by June 30, well, your acquisition people get their bonus by how much they bought, not the return they get for investors. So, and they'll go and spend that. That's not how we look at it. Because we have private investors, if something goes wrong, they call me, which is fair enough. I don't have a problem with that. Like we will go years when we don't buy anything. And then, we bought those 2 great shopping centres in Darwin and Mackay in 22, and they're irreplaceable assets.
But there must be times when that institutional money that will buy because they've basically got to do something with it sort of blocks you out of the market, because then they'll start paying silly prices, right?
That's fine. And I mentioned, I don't know if I mentioned before, but what they forget is about cycles. They go in cycles. So we weren't buying when they were, and now they're selling and we're buying.
So if we say that the commercial property topped out 2021, you've been doing this a long time now. Roughly how long does that upcycle run for? 4 years, 5 years? Or you don't dare guess, as it were?
They say they sort of go in 7-year cycles, and it's and I think they vary between 5 and 10 depending what's happening. But we were still buying things in 2016. I was just finished listening to a Charlie Munger book, and as people don't know, Warren Buffett's partner, he died at 99. And one of the things that he said is what smart people do in the beginning, fools do in the end. Now, what he may mean is that the smart people were buying industrial at 8, 10, 11% in 2016. He might say they're the smart people, and he might say the fools who are buying at 3.25% in 2021 were fools. Now, I'm not saying that, but that may be what he's referring to. You'll see in any cycle, some people get in early, and I think in any sector, Callum, more people buy at the top than the bottom. That's just what happens. Stock markets, residential housing, whatever it is, and most people, they want to go along with the herd. They want to go to the hotel, the restaurant, speak to all their friends, and, well, I'm just buying a house on the weekend. Oh, well, I was going to do that. That's a smart time. What a great time to buy it. Now, I know when we started in 2010, and plenty of people laughed at us that we're going to send all our investors broke and everything else. And, in the last 13 years, we bought 3.1 billion, sold.
Well, as you know, I told you I had that experience last year when I was trying to tell everybody to buy the stock market. Just can't get through. It's very hard to cut through.
We've sold 1.1 billion, average 19.6 internal rate of return. We've just sold one asset, settled last week. We bought that in October 2010. We've averaged over 20% internal rate of return after paying average 12% distributions for 13 years. So you've actually got to be, the old Warren Buffett. You've got to be buying when fearful and others are greedy when others are fearful. But not a lot of people can do that. They want the pats on the back to say, geez, that's a smart buy.
Well, it just feels easy too, right? Like everything's right at the top, basically. Yeah,
and that's not. I'm quite comfortable with people laughing at me. It's I don't have people that I respect laugh at me. And it's and people can say whatever they like, but our track record is there. And I know there's a lot of other funds that will say, well, our funds under management gone from 1 billion to 100 billion. How good are we? But I think if you have a look at the peak of the REIT index, which might have been 21 or 22, it still wasn't back to where it was in 2007.
I think that's true, yeah.
So after 15 years, they still haven't recovered. But if you have a look from the bottom to where they were, they'll say it's great, but there's a lot of people who are still behind. So,
well, it's funny you mentioned that because you alluded to Chadstone earlier off camera, and that's still below that particular vicinity and centre group are still below their previous highs. This is a very specific for our marketing manager who moved to Queensland. Would you believe she bought a house in a suburb called Currimundi? Have you heard of that one? Is that any good, or has she bought a dud?
You want to spell it again? 'Cause there's no such suburb as that.
Carrimundi. It's Carrimundi?
Carramundi?
Carramundi?
I think it's up the Sunshine Coast.
Yes.
Yes.
Has she bought a dud, or how do you feel about Nat's
I couldn't
purchase?
tell you.
Have you got anything around there?
No. I don't get in the Sunshine Coast because the traffic's a bit difficult getting up there. But certainly it's some investors and friends of ours have got a very, very large investment up the Sunshine Coast. It's done enormously well for them.
It is booming, that area, though, isn't it?
Oh, it is. And for good reason. It's a good lifestyle. They're supposed to be putting in the train line, but our government aren't very good economic managers, and when they just...
When you say you mean the Queensland government?
Yes. Yeah. Well, anyway, we'll target them now. But they've been going to do the railway up there for a long, long time, and the costs are just completely out of control. So we need that. You know, I have a holiday unit on the Gold Coast, and the traffic going, even Friday afternoon at sort of 5 o'clock, I can get there when it's absolute disaster in probably an hour and 20. Sunshine Coast is 3 hours. So that's why I don't go up there. But
do you mind if I borrow that sometime? Take the kids to the
car? No, you can loan the car.
The unit.
Oh, the unit. Oh, sorry. Okay. Oh, of course, the keys in the letterbox.
Oh, cheers, buddy.
But the Sunshine Coast, but the Sunshine Coast covers, I don't know whether it's 100 kilometres or something from Caloundra up past Noosa. So it covers a massive area, then goes inland a bit, I suppose, almost to Gympie or something like that. So a lot of growth. It's going to keep on going. You've seen the price growth just go through the roof. But still, I think the average house price in the Gold Coast, Brisbane and the Sunshine Coast is still lower than Sydney and Melbourne. And when you look at the taxes down here, I've met with a lot of investors and other people over the last couple of days here, and one of them said he just wonders why your former Premier is getting such a pension when he should be paying for all the damage he caused now. That's not my opinion, that's just some other people.
Yeah,
and people can be unkind. But it's... the taxes that they brought in here, I just don't know why.
Does that hit the commercial side, or is that?
Oh, for sure.
Yeah.
Well, one thing it does is stop new businesses coming here. And why would a business expand here? And I can understand that you just can't. Yeah, I can't remember them. You'd know if you turned over $100 million, there's some new levies that just, they must have had a real think tank and got on the marijuana or whatever it was to come up with some of these things. Like, they're pretty wild. So, of course it does. It makes cost of living dearer. So for your average worker, and a friend of mine, he's got 4 boys, he said if he didn't have the children, he would just move to Queensland. It came out, I think this morning, that Victoria's the highest tax state in Australia and got the highest debt. Now, I don't think that would surprise anyone. And the taxes that they put in aren't doing anything to encourage more people to move here or business to expand. Why would you? You've and I think, I can't remember who it was, but you can't tax a country into prosperity. You need to reduce taxes to stimulate growth, and then that's how you get it going. But that's not what they did. They've got massive debt, and it's just...
Well, we've been here before, right? You started when Victoria was on the ropes back in 1989 and all that type of thing.
Well,
here we are again. First
property we bought in Melbourne was the Virgin Active Gym in Burke Street, and who would think a strata tile gym would make money? And in under 4 years, we got a 33.1% internal rate return. So we were fortunate. And the last property we sold was property we had at Sunshine, 50 acres on the corner of, is it Ballarat Road or whatever the main road is, and McIntyre Street, 70,000 cars a day, and we, I think, tripled our equity in about 3 years. So we've been out of Victoria altogether, but we bought back in, but at the 9.3%, that takes net return day one. That takes into account the increased land tax, increased rates and all those other things. But there's a terrible amount of pain for people here. And I just, the things that Western Australia has and Queensland have, if you can get a massive bump in the coal price or iron ore price of those, the government's going to get a massive windfall that can sort some things out. Our government in Queensland doesn't sort things out, they'll just spend more. But that's another thing.
Well, at least they're renting your office block, right?
I'm renting a few of them, yeah. But in Victoria, you don't have those things that can help get you out of that financial trouble. So it's quite difficult. I know there's a lot of great things about Melbourne, the quality of life and everything else, but it's the economy's in trouble, and I don't know they stopped the fracking, they stopped more oil, they stopped all these other things that actually bring in the big amounts of money. And I know the greenies don't like it, but if you're eating the paint off the wall, I think you might be a little bit more tolerant. But anyway.
We'll see. All right, mate. It's been a pleasure. So if anyone's interested in what you're doing, Sentinel website or ring up the
just have a look. And
are you doing a presentation down here anytime soon?
We've got one coming up in June to our investors. We do it every 6 months and just run through with investors, and they can ask whatever questions they like. We're very open. You've been to a couple of ours. You've seen Callum, and
I have. Yep.
We don't get everything right every day, but over the long run, and I think the most important thing with property, as long as you buy it at the right price, if you don't have to sell in a depressed market, very, very rarely do you lose money. So the secret is being able to hold them through difficult times, and not everyone can do that. But if you bought at the top, you've got a problem. But it's like everything. You've just got to be patient, and just whether it's housing, whatever it is, if you're going to buy a house, I say to my young people, young staff, you've got to be looking all the time. Look every week. You can look at a house and say, I don't really like it. In a month's time, you say, gee, that house at Caulfield was cheap?
Or Caramundi.
Caramundi. Yeah. But it's sold. So what you've got to be is, my COO who lives down the coast, buying a unit so he can stay in the city a couple of nights a week. We went and looked at a unit in Mary Street in the city in Brisbane last Thursday, and we came out and we said we'll settle in 21 days. It's a nick. It's less than a quarter of replacement cost. So whatever you're buying, whether it's cars, you've got to be in the market. You've got to know the info. Stock market the same. You don't start having a look and then because the good deals are gone. You've got to be, whatever you're doing,
Got to be watching.
Be on top of the market.
Well, we'll leave it there. Thanks, buddy.
Thanks, Callum.
Pleasure.